Okay. Hello, everyone. I'm glad to be back on stage again to discuss a topic that it sounds like every panel wanted to discuss throughout the day, which is politicization of climate change. I don't even have to state why this has been so important because this was part of the conversation all along. But we do expect climate has turned into a divisive topic, and that's what we're going to explore in our next panel. I'd like to start by asking everyone on the panel to introduce themselves and talk a little bit about their connection to the topic, and then we'll get right in.
Hello, everyone. My name is Kristen Hill. I'm a partner at Morrison & Forrester here in San Francisco. My area of practice is investor litigation. I defend companies and their shareholders companies and their board of directors when they're sued by their shareholders. This intersects with ESG because investors are suing companies over their ESG disclosures. So I have happily joined our firm's ESG task force, which is, of course, led by Suze, and we get to talk about a lot of really interesting issues and represent clients in a lot of interesting cases that are about ESG disclosures. So I'm happy to be here today.
So my name is Amelia Miazad, and I am a law professor at UC Davis School of Law, and my research focuses on environmental and social risks and corporate governance. And more recently, I've been focusing on climate risk in particular. So my last project was on investor climate alliances and how investors are collaborating more than ever, but there are hurdles, specifically corporate law hurdles, preventing that collaboration, antitrust and securities law. And my project before that was on director and officer liability insurers acting as climate risk monitors. Because, as you know, there's a lot of D&O insurance, or the threat of D&O insurance, with respect to climate commitments and what companies are actually doing to address climate risk.
Hi, I'm Katie Schmitz-Hewlett. I lead investor engagement for the International Sustainability Standards Board, and I come to that work by way of a heritage at the Sustainability Accounting Standards Board that was born just across the bay. And my work is focused on, as my title might imply, on helping ensure that disclosure meets investor needs. So I think that is somehow how I wound up in this panel. But I'll just preface my remarks by saying that I'm going to be speaking as a human being on this planet and not as a representative of the IFRS Foundation or the ISSB, and all of my remarks will be my own.
Fantastic. I'm Jeff Johnson. I'm not a lawyer, so I thought to take the non-lawyer chair that Nicole was in before. I'm a general partner at an investment firm called B Capital. Before this, I was at Temasek, where I spent several years leading the firm's sustainable investing team. And before that, I've done lots of things, worked at big companies, co-founded a couple startups, worked at other startups, et cetera, et cetera. So been doing climate a long time and excited to be here. Thanks. And I also know we are between you and happy hour, so we'll do our best to keep it not boring.
We are the happiest hour, that's why. So I wanted to start with kind of the facts of where we are and how we ended up here. So we've seen politicization around climate change and growing. We've seen politicization raising hurdles in how we understand climate and disclosure, in how corporations make disclosures. We've seen states passing laws penalizing investment funds that purport to make investments in green companies or ESG companies or against fossil fuel companies. So my first question would be, do these moves reverberate in the markets? Do they really have an impact? Do they change how companies behave and in what ways? And also, do they change investment strategies and how investors think about what they're going to do in the future? So I have this kind of marked for Katie and Jeff, but please feel free to jump in at any point. And let's see what Katie thinks as a human being.
Thank you. So I think as we've heard from other panels earlier today, I don't think it's changing strategies as much as it's changing the way people talk about strategies. And so all the things that you've been hearing, green hushing, is a thing, it's happening, but the fundamental underlying strategies, in my view, for investors who are authentically looking at these as risks and opportunities, remains unchanged. It's, I think, more of a communication shift that we're seeing. I don't know.
Yeah, I mean, as someone who invests other people's money, my job is to earn a return. And so I think you can look at this whole space and say, how do you invest those dollars appropriately to earn the return that you need? And if you take a long-term view, this issue about sustainability and decarbonization and climate change is kind of a problem that has to be solved and will be solved. I think the question for me is more one of, how fast is and how long is it going to take, and what solutions do we have today versus what do we still need? And so a lot of this talk about green hushing and greenwashing, there's, Larry Fink just put his latest letter out, and more nuanced with how some of these things get talked about. I actually think that's really good, because what we're getting to is kind of normalization of how we talk about these issues that hopefully more people can rally around. I mean, I go, talk to lots of different folks, and if I've been in rooms like this with lots of people from the oil and gas industry, and the best way to have a conversation there is to engage. If I come in saying, your business is terrible, all of you are horrible people, that immediately gives rise to this politicization effect we're talking about. But if I can recognize the fact that, what oil and gas has done is allowed, the economy we live in today to work. It's allowed a lot of people to eat cost effectively. It's done a lot of things that are good. It has this very big problem, and we have to find a solution to that. And you find ways to try to drive, engagement and inclusivity. It tends to go a long way. So I mean, I just think that figuring out how we bring more people around this as a solution we all want to work on together, and find ways to have real wins is what we have to do. I mean, I was reflecting a lot on the conversation earlier about talking about measurement and accounting, and we don't have debates about whether we should measure financial performance. There's accountants who, I am not one, are going to argue about GAAP rule interpretations and IFRS this and that, and that's great. But nobody's saying should we or should we not measure the financial performance of the company. That's obvious. We're not there on emissions yet. We're getting there. And when you take that even further, we're certainly not there on how you allocate capital and how you think about returns and how you manage risk. And so I do think that we've got a lot of work to do to get there. And developing a better and shared language, I think, can help.
Can I jump in on that point? Mm-hmm. So I agree and disagree with that. So I am actually very worried about the green hushing for the following reason. So I started a research project where I interviewed corporate executives, specifically heads of communication and general counsel and sustainability counsel, very preliminary. But what I found was a pattern, which is internally, everything is still, resourced as it was before the ESG backlash. But the communication is very different. So in the public domain, we are not using the word climate, at least not in all markets. So, one insurer said, we don't use a C word in Texas, right? Mm-hmm. We heard that, that's climate. And we heard that on a couple of times today. And the reason why that worries me is because our norms are not where they are with respect to financial risk still. I mean, I was at Berkeley conferences in this room 10 years ago where we were saying, is it values or value? And we're kind of actually, the same themes are coming up again today. And I think if we are not equating climate risk with financial risk over and over again in the public domain, then those business norms are going to start seeping into how companies are resourcing these initiatives internally, at least to an extent, and we do not have any time to waste.
I will just echo what was just said. Now, the question was, what have investment strategies changed? So we're investing, right, in an environment that is evolving, that is shifting. Whereas before, the greatest investment risk when you're just talking about your investment disclosures, your investment strategies, maybe the greatest risk was you were going to overstate your commitment to climate and to the environment, and that you were going to be sued as a result of saying out loud, we're fully committed to, a sustainable, we've created this great carbon emission goal and we're all for it. That may have been the greatest risk once upon a time. That risk is not the same anymore. Now you have to be worried about investors who are going to say you have overstated your commitment to sustainability, and simultaneously a whole nother set of investors who are saying the exact opposite. You've over-focused, right? You've over-committed to climate and to the environment. And that, I think, puts companies, obviously, in a really tight spot. They're navigating really challenging waters where they're trying to satisfy multiple stakeholders at the same time who are saying very different things.
Which just encourages you to say nothing.
Yeah, well,
Which is very not good.
Or to get more crisp and clear about what you're saying and why. And I think that's the opportunity here. And I hope if we can, not waste a good crisis, that's what comes out of this. So I think calling transition financing, when you're talking to oil and gas executives, that might help them lean in a little bit to a conversation, as opposed to the murky, conspiracy theory now laden, like, what is ESG? What does it even mean? And if you start talking about, we understand that you've helped the economy function and will continue to help the economy function for years to come, but we're also transitioning and recognize that we must transition and we don't have time to waste. So that, I think, helps bring things into focus in a way that has been hard before and has made a big target out of this mysterious label of ESG. So if we can get down to brass tacks, I think, and help people really understand what is it we're actually talking about, I think it can be helpful over time.
So I've been trying to suppress my professor instincts, but it's getting harder and harder. So I will point out that this kind of the phenomenon that you're describing, and especially the way Kristen framed it, is, I think, what motivates the whole conference. So for many, many years, we've thought that shareholders had one goal, and Jeff mentioned it. It's like, my goal is to make more returns. Yes, great. But now the discussion about how to get there it's been so divided. People have very different views on how to get more returns that this division has become a problem for boards. And that's where we are today, and that's kind of the outcome of this politicization. And I'm personally very interested in that and how companies will approach it, but I won't talk to you about this. I'll talk to you about this in a moment. So I want to go to Amelia next, because one of the issues that on the one hand, we said investment strategies aren't changing, right? So that was kind of, I think, the broad consensus. But we saw big asset managers, big investors kind of pulling back from the climate alliances that you're working on, Climate Action 100+. This was a big effort by many in the asset management industry to rein in corporations. And initially, BlackRock, State Street, had joined, but now they've pulled back. The same with JP Morgan and PIMCO. So tell us more about this move, and tell us more about how we should understand it and what does it mean for the investor world in this space.
Okay. Yeah, I still am traumatized by that, because the announcement was made. The announcement was made the day I was submitting my law review article celebrating BlackRock and its participation in Climate Action 100+, and then I spent the next week rewriting the article. But look, I think that the benefit and the power of climate alliances like Climate Action 100+ is in supporting efforts by pension funds, sovereign wealth funds, faith investors, and other investors, not necessarily the asset managers. They were late to the game. They were late to joining Climate Action 100+. And Climate Action 100 Plus will still serve its function of helping these pension funds share information and also divide the monitoring burden. Because the problem before was that there are so many companies to engage with, and limited staff, limited time. And what these investor alliances do is allow for collaborative engagement, stewardship, information sharing. Now, the hurdles are antitrust, as Tim talked about, and as actually I've talked about with Tim. Thank you for the help on the paper. And securities and investor fiduciary duties. And I think corporate law was designed with really a single firm focus, and climate risk requires collaborative efforts, not only by corporations, but also by investors. And so corporate law needs to retool for an era of collaboration.
So do you expect BlackRock to vote differently or to behave differently as a result of that?
I do think that BlackRock is susceptible to political pressure and public pressure, and I do think that we're going to see a chilling in not only speech but in action. I think that the politics will affect the behavior. I mean, just to make this concrete, the legislation that's been passed in about 26 states now, what does that say? That says climate risk or financial risk. Asset managers can only consider financial risk. Let us define financial risk. Financial risk is not climate risk, DEI, et cetera, et cetera, et cetera. So essentially, climate risk has been defined out of investment risk in this legislation. However, that legislation is very hard to, it has no teeth, right? But I still think it's going to have an impact.
But it's an interesting question to kind of dig into, which is this question as an asset manager, thinking about, if you're not supposed to take climate risk into account, but your job is to make money, how much should asset managers be investing in climate positive solutions that don't make money? How do we think about that? I mean, the role of kind of government and other people is to either regulate things into existence or do things like the IRA, which provides a nice carrot to help get people to do the right things. But it is, for me, an interesting question, which is to say, I think it's not sort of reasonable to look to have private investors try to invest in inflationary solutions that are challenging. I do think we have to kind of ask these bigger questions and figure out how we get to the point that we can have either legislation or more of the right tax incentives and other things in place to allow these solutions to really work. And I think that, coming back to the kind of topic at hand for this panel, is kind of core to the challenge. I mean, I think as an investor, if there were just a price on carbon, bang, that fixes an awful lot. We're not getting there, I don't think, anytime soon. And we keep trying to bubble up solutions and find ways around the fact that we don't really have the consensus to do the thing that makes it at least most efficient to get us where we need to go.
But just adding on to that, though, we were kind of falling into the bad habit of speaking of investors as though they're all a monolith and they're all doing the same thing at the same time, and there's a broad spectrum of investor activity, right? So you've got California pension plans that have identified climate as one of the key things that they need to be investing billions into, and they're doing it in a variety of ways. So it's not only public markets, it's private, there's a broad array of because they have different risk appetites, they have different time horizons, they understand, the pension plans in particular, that they need to be able to pay their beneficiaries out 100 years, but if the world is on fire or underwater in 100 years, what's the point? And so they're trying to solve for that as well. So I think we have to be a little bit more disciplined about the way we talk about investors and their activities, and understanding that there are some private markets. We just heard the prior panel talking about investments in transitioning companies in hard to abate sectors, brown assets, all of those things. And so it's going to take place on a variety of different levels and at different paces.
Katie, I wanted to ask. So I think we have a broad sense of how investors are dealing with politicization. I wanted to move now to how companies are dealing with it, from the standard setter's perspective, do you see companies stance towards the standards change or the adoption change as a result of this political pressure? Is it slowing transition? Is it slowing adoption? Is it slowing changes that need to happen within companies, or not so much?
I think it varies. I think what you're seeing is, as we've heard throughout the day, the direction of travel is pretty clear. If you're skating to where the puck is going, it's going in the direction of figure this out, get your disclosures in order. And so you can try to bury your head in the sand. You can, sue whoever you want. But at the end of the day, you're going to need to be able to produce disclosure at a higher level than has perhaps been the norm in the past. So I think most companies, most S&P 500, 1,000, top tier companies understand that this is now table stakes. It's not optional because they're either scoped into the European requirements or California requirements. So you can run, but you can't hide at this point.
Christina, is that the same you see? Because you also advise clients on how to set up internal ESG operations. So is this your impression too?
Yeah, so I don't see companies firing their sustainability officers. I haven't seen that yet. I think is happening here is the same thing that we see tracking in the DEI space, right? As you've seen in the attack on DEI, it's similar to the attack on climate. And so now, as I think it was Amelia said, what mostly happens is the language changes, right? The way we talk about it changes. So maybe you don't keep saying DEI and maybe you don't keep saying climate. Maybe you say sustainability. I feel like that's safer than climate, maybe. But you've got to change the language. You've got to adjust to a new environment where there are different attacks, and being responsive to the language and how you talk about that does become really important. I will just say the litigation risk is real. I think, if you don't mind me just giving you a little bit of a preview, state AGs are very focused on this issue, right? I think there's 20 state AGs who have opened formal inquiries into state pension funds and how they're investing. There's so much focus on this area, and they are not going to stop anytime soon. More to come. As you well know, I think it's been well publicized that the New York City Employee Retirement Fund has been sued. That litigation, the motion to dismiss, is currently pending. We will wait and see what happens. The allegation there is that the disinvestment into fossil fuel industries is harming that pension fund. And so the ruling in that case is going to have a big impact, right? If disinvestment in industries that are harmful to the environment is causing litigation, and that you have to be thoughtful about that could have an impact on how you're investing and what investment decisions that you're making. There's a similar lawsuit, or somewhat similar lawsuit, against American Airlines and their pension fund, and about how they are investing in carbon neutral and decarbonization. That is super important. And again, we're waiting to see how that litigation shakes out. It's still relatively new, but there is real activity happening in that front. It's not just imagined risk, it's real risk.
So, Kristen, since you opened the door for the litigation questions, I'll keep them coming. So my first question is, how final is the final SEC rule? So it's for a while we've been talking about it. The prospect of litigation against that rule was kind of raised from the beginning. I know that predicting the outcome of litigation is the question that no lawyer wants to be asked whatsoever. But I wanted to first gauge your thoughts on how you think this is going to go, and then I will ask you about how do you advise your clients to deal with it.
So I'll give you a prediction. I'll stand by. It's going to take a really long time. We're not going to get resolution on this for years to come, which is the reality of things. As you know, the rules were announced, I think it was March 6th. Within 10 days, there were 9 litigations filed challenging the rules in some degree. One court, the Fifth Circuit Court of Appeals, had entered a stay. Then the SEC moved to consolidate an MDL. That consolidation happened. It's now in front of the Eighth Circuit. There has been a movement to stay the rules as these litigations continue. I think that hasn't been decided yet. It was literally just argued yesterday. So this is breaking news. We're still trying to figure out exactly what's going to happen. But I can tell you, it's going to take time. the wheels of justice move slowly. I know there are many lawyers in the room. You know that. This is not a quick fix. It will end up in front of the Supreme Court. Who knows whether or not and to what extent the Supreme Court will change by that point, maybe not at all, who knows. But in the meantime, there are gonna be, potentially changes in Congress that will impact, it's possible that they will intervene. Obviously, there's a presidential election looming, that could have an impact. This is the title of this panel is perfectly apt. It is a political issue, right? It's not just a litigation issue. It is a political issue. And so the very firm prediction I can give you on the litigation is that it will take several years. And in the meantime, the political landscape will continue to shift. And so when it finally does get to a point where resolution could be had, we'll see what the world looks like, because it could look very different.
So how do we deal with this from a corporate governance perspective, like from this political risk? On the one hand, we have this kind of wave of disclosure looming. On the other hand, what shape is this going to take, and what kind of advice do we provide companies about how to deal with this political risk?
Yeah, I'll weigh in, and I'm sure that my fellow panelists would like to speak as well on this topic. So number one, the SEC rules are, they're not going to be the ones that are going to move the needle. So that's okay. There's a lot of other rules out there, a lot of other disclosure requirements that are important that, as my colleagues have mentioned, that are going to set the stage. European rules, California rules, all of those are going to come into play probably before the SEC rules become meaningfully enforced. In the meantime, that doesn't mean you can just stop everything and wait to see what happens with the SEC. These processes take time. Right? The implementation of these processes, the procedures take time. And so I don't think anybody should sit on their laurels and wait and see, okay, what happens with the SEC? I think act now to create the policies and procedures that will allow for compliance with the SEC regime, knowing that you're probably simultaneously complying with the new European rules, the new California rules that are likely to impact your business perhaps more quickly.
Yeah, just jumping in on that. So, insurers and insurance is really interesting in this space. It's where the rubber meets the road, no pun intended. But director and officer liability insurers in particular are looking at governance, at how the board is overseeing risk, at the gap between what companies are saying and what companies are doing. And I think that pressure is for companies just as strong, if not stronger, that private regulation than the SEC rule.
And now I will put my ISSB hat on. But before there was the SEC rule, and the SEC rule refers to TCFD, ISSB standards bake into the structure and the architecture of our standards, the TCFD. Not only for climate disclosure, but also for sustainability disclosure writ large. And why is that? Because it's such a simple, elegant, easy for boards to figure out, we've got to have these things in order. And it was very popular in hundreds of jurisdictions and mandated in many before ISSB was even formed. So at the core of ISSB standards, it's sort of a great passport. We're starting to use that language, a passport that you can use to navigate through this disclosure landscape as it evolves, quickly or slowly, depending on where you are. And most companies have been doing something like this for a very long time. And so it doesn't make sense to say, well, we're going to just stop. You've already made the investments to be doing that disclosure in some way or another, using standards and frameworks like TCFD and SASB, perhaps GRI, perhaps others. So don't wait for outcomes at the Supreme Court when your investors are asking for this information today. And ISSB standards are available and ready to use off the shelf, and can help you with both the European disclosure as well as the SEC requirements someday, and California.
Look, I would just add a couple. For boards and management, ultimately climate represents, we've talked a lot of risk, and then obviously there is risk, and that's important to understand. There's also opportunity. And I do think that no matter what business you're in, from Google or an Alphabet that have a relatively light footprint in many ways when it comes to emissions, especially given all the good work they've done on 24/7, emission-free energy, through very hard to abate sectors. I mean, there's opportunity in all of that, and I would say the direction of travel very much is that this is something people care about broadly. These are issues that are moving in the right direction. So I would just say, for the lawyers in the room, everybody can worry about the risk, and it's important to think about that, and you got to manage it appropriately. But I think there's a huge win for companies to, even if they're doing very, very heavy emitting businesses, there's a way to win in a future that is better. And so understanding how to be a part of that and lead is important.
Okay, so it's so what I'm kind of hearing from all of you is that yes, politicization has changing the tone. There's a concern about how that is going to affect how we build norms, but ultimately investor strategies are determined by returns, and that returns are going to be kind of not as affected by political factors as perhaps politicians would like to believe, and companies are reacting to more long-term kind of trends. Now, so that begs the question, or I can, in two different ways, but that begs the question, okay, why then has climate become this kind of hotbed issue? Is this a US phenomenon? Is it a global phenomenon? And how are we going? What is different about the US political scene? And I can ask this in a very broad way, what is different about the US? And I can also ask it in a very specific way, which is why 24,000 letters for the SEC if you're all right that it's not changing things very much, right? So who wants to take the broad one? Who wants to take the simple one? Who wants to take both of them?
I'll start. I think the issue with this topic is that it's been turned into a zero-sum game of winners and losers. Mm-hmm. And if you're on if you're on one side or the other, that dictates kind of what you think and how you feel and how you interact with the folks on the other side. And I do think this is a big part of the challenge. And I don't think it's a U.S. issue. We're seeing it in lots of other parts of the world. Obviously, places like Europe have some very encouraging things happening from a decarbonization and climate perspective, whether it's the Carter border adjustment mechanisms and things happening. A lot of people look at that and say, hey, those are set, those are done, but there could be political changes there too that could bring those back. I think it's at least my job as an investor is to assess risk, and so all of that just increases the risk. This issue of looking at this as very much kind of winners and losers creates more risk and makes it harder to invest, because you can't count on certain things as being there for the long term. So I do think if we can, kind of getting back to my initial comment, find ways to bring more people together on this, it really goes a long way.
Yeah, I think we talked about this in our prep call, and I think it has a lot to do with just the fear factor and how poorly we've managed a change management exercise, right? Because this is a massive change management exercise, and some people may feel better prepared for that, and they're going to be all for it, and those who are feeling a little bit behind are going to be like, whoa, and it kind of triggers stages of grief, first denial, anger, and I think we're seeing that all kind of play out, and then you get to realization, oh, okay, we have to move forward, But we have this time-critical problem with climate that investors and Spencer's presentation just brought that into very clear focus. If anybody needed it to be even clearer, the models have been right for 40 years. And investors understand that. They understand the risks, but they do also understand the opportunities. But we have talked about this as kind of this winners and losers, zero-sum game. Some of the early sustainability, sort of lingo was focused on what you have to give up and what turn the lights out, and all of that is giving something up and losing something in a certain way. So let's jetson this, right? Let's give a mental jetpack to people and help them kind of figure out that this transition can bring lots of change for sure, but so much of it can be positive. But we have not done a very good job of articulating that, in my view.
Mm-hmm. I think it's
Okay, so I'm trying to suppress my academic professorial urges more than Stavros is suppressing his, and I'll just kind of share a story that made me hopeful. So my project that I'm working on right now is on faith investors. Okay, because we all need to pray about climate. Okay? And faith investors are really interesting with respect to climate change in particular because they've been on the front lines of this for decades. I mean, some of the first shareholder proposals at Exxon were filed by faith investors and these investors continue to exert pressure. Recently, there was a faith investor, Baptist faith investor, relatively new, who in 2022 changed all of the funds, the ETFs, to include ESG. And then in August of 2022, removed ESG and sort of waged war against ESG and said, I'm not using the term is Marxist and it's progressive and it doesn't represent faith investors, et cetera. And so I asked, okay, so what do you use for the screening? SASB, the 26 SASB standards. So I cannot overstate the value and this sort of coalition building and coalescing that standard setting and standard setters have. And I just thought that was fabulous.
Can I just pile on here? As one might expect. So I think it's really interesting because you also mentioned the lawsuits that are saying you can only focus on pecuniary factors. And that's exactly what SASB standards do, putting a lens over the swirling array of issues that one could be looking at to help investors really focus on the intersection between a company in a given sector, given industry, and saying, well, what are the things that are likely to affect value over time? What are the things that I should be looking out as risk factors? And so it's agnostic. It's just a better lens on information, giving investors better information to make better decisions. So it's great to hear that.
Truly agnostic.
So don't mention that to the faith investors, that it's agnostic. So that my next set of questions is, okay, we have a degree of politicization in the US that is higher than you see in other countries, because the issue is not completely depoliticized in other countries as well. Nobody exactly treats it like science, but there are political conflicts around it everywhere. But the level that we see, the level of division that we see in the US is particularly high. Now, my next set of questions was, do you guys have any suggestions about how we get out of there and how do we build consensus? So now standards was mentioned as one example. Jeff, you started saying we need to get out of the divide and we need to start building consensus. And your first example was about that. So what are your ideas about how to start building consensus or more agreement or more alignment, however you want to put it, and then I'll come
Yeah,
to
I mean, what's interesting is people a lot of times forget that the U.S. is a huge oil and gas country, right? And so that is one of the reasons why we have this is because, again, coming back to what happens if you shift away from that. There's big parts of the country that lose something in that sense, and so there's questions about how do you bring that industry into the dialogue and kind of along. And I think that is something that's important. And the more we can figure out how to do that, the better. And there's obviously a lot of expertise that can be leveraged and put to work. It's hard. A lot of the solutions, I mean, we were talking earlier panels about hydrogen, some of these other things. It's very hard. It's very expensive today. It's unclear how we're going to get to some of the cost competitiveness, but we have to try. There's people looking for, drilling for hydrogen. And, if you can figure that out, that could be hugely cost competitive. So I do think what we have to do is figure out how to, encourage companies to have ways to invest in the solutions and be kind of celebrated for that and bring people along. And I think that's, frankly, the way we're going to get there is if people see there's an opportunity to make money and ultimately produce returns, then that's how this is going to work. Obviously, the other solution is if you get to the point where you start pricing and regulating things more strongly, that'll have a different impact and probably a different reaction. But I do think there's a way to kind of find a pathway for people to share success.
Perfect. Kristen, how do you see companies navigating this politicization divide, and what are the best ways they've come up with to go past this and get different groups of stakeholders that have different preferences kind of unite under what the company is doing, and or at least, not challenge the board in every opportunity?
Well, all of this makes me think of antitrust concerns. So let's all be very careful here as we continue to work together to collaborate on how to solve these very tough problems. Other than that, setting that aside for a moment, I really do think that there are real opportunities here for companies to really invest in those sustainability reports and how they are crafting those reports. I think somebody mentioned earlier, Katie, I believe it was you, the importance of really drilling down on what are the relevant metrics for your company and how to make sure that those relevant metrics ring loud and clear in your sustainability reporting. That is so critical, right? These are really important documents. I'll tell you right now, the plaintiff's bar looks at them too, not just your investors, right? They're read broadly by lots of different stakeholders, but spending the time to get those right and to really get good controls and processes around those reports are really good. And read not just your own sustainability reports, but those of your peers and in your industry, because I think those reports are really critical for moving the ball forward.
Can I ask, what kinds of criticism does the plaintiff's bar sees on sustainability reporting?
So here, I'll tell you something that for some reason I think a lot of people don't understand. So people think of securities litigation risk around your 10K, right? Like, what are you putting in your financial reports? Let me tell you, the plaintiff's bar, they look at your financial reports. They care a lot more about those softer things, right? Because they are not checked as closely, right? So you've got auditors that are really crossing every T, dotting every I, doing a million calculations on everything that goes into your financial reports. But you're not necessarily applying that same level of scrutiny to these softer documents. And so the plaintiff's bar says, ooh, look, they're not paying that close attention to these. This is an area that's ripe for my attack. And so we see that same thing happening, right? If you are issuing a sustainability report where you're not doing that same type of checking, we love so many companies have issued really wonderful carbon goals. I love it. It's so great. We love to see it. Make sure you've checked that out, right? That you have something to back that up, that as you progress towards those goals and you are affirming and recommitting to those goals, that there is concrete evidence behind that pursuit. Because if there is not, the plaintiff's bar will come in and say, hey, wait a second, you said you were going to get to this goal by this point and that you were going to meet these certain benchmarks along the way. You have not met those benchmarks. You lied to me, and I will sue you. And then you'll have to hire me. And you don't want to hire me. So there you go.
Great.
And on that,
It's almost over.
and on that point, the D&O insurers are doing the same thing, are asking, is your sustainability report audited? And in the due diligence process, and in the underwriting process.
So the beauty of standards, right? And the elevation of the quality of the sustainability disclosure so that it's at the same level, subject to the same controls, processes, scrutiny as financial reporting. That's something to be celebrated.
Great. So from the beginning, everybody has been mentioning the importance that the November election might have for climate disclosure or for climate change policies more generally. So we are the politicization panel. So we have to discuss the importance of this, the way we see it reverberating in the work that we do. So I'll ask you to give me your thoughts on how this is going to affect the future, depending on how it turns out and what we should be expecting. We've heard all range of responses from it's going to be only bad and nothing good can come out of it to no, it's going to be kind of more nuanced and there are aspects of it that are going to be even reinforced. So how do we think about all that? Jeff, do you want to start?
Sure.
Yeah.
How many people in the room here have read the Heritage Foundation's Project 2025 report? I'm proud that there's 6 of you that have done that. Everybody should read it. 7, sorry. Everybody should read it. Just because I do think that is some very insightful document that kind of gives a sense of what the priorities would look like.
What does it say?
It's a very long document.
We need to do this after cocktail hour.
No, I mean, look, it's a very long document. What I would say is that there's a lot of things in there, I'm going to guess, that people who care about climate would vehemently disagree with, and parts of it you go, okay, that makes some sense. And so I think that kind of speaks to my perspective on where a lot of this is going to go, which is going to say it's depending upon what happens, we're likely going to get some kind of mixed form of government. We're probably going to not have one party aligned on House, Senate, White House, which means only so much can actually really get done. And I think again we all know what the priorities of the current administration are, and again the Heritage Project 2025 gives a pretty good view of what the priorities would be on the other side if they were to take power. And what happens will probably be somewhere in the middle. So I think that there's a lot of reasons. I mean, we talked about state and local kind of government stepping up to continue to kind of carry the torch on making sure there's still a focus on driving as much support for decarbonization solutions. That will certainly continue. Obviously there are red states seeing a lot of benefits out of the IRA. I will share one anecdote though. One of my previous portfolio companies was a company that had a particular energy storage related solution and went to go try and get approval for something in Texas, fully economic, full benefit. County Commission said no, that seemed like some of that green stuff we just don't want to be doing around here. And that's the reality of the risk. And so I think that's where we just have to accept that that's going to happen and keep fighting and find ways for the right technologies that are deflationary, that can actually deliver kind of climate benefits, have the ability to get out there.
Yeah, I can't make any predictions, but I mean, ask yourself, would we rather have the IRA and the infrastructure bill, the largest, investments of their kind in the world? Would we rather have that or less of it? And I think, we know that deal flow has shifted to the U.S. as a result of the IRA and the inflation, the Infrastructure Act. So that's net positive in not only for red states but all over the place. Why wouldn't we want more of that? So I think as you're out there in your markets, ask those questions. Ask people those questions. It's that. Do you want to be for something or against it? And I think that's really what I think it boils down to. Let's be for better jobs, cleaner energy, a transition. We're not saying we're going to turn the spigots off tomorrow. We all need, to fly and all of that good stuff. It's not going to change overnight, but we need to be making the investments to the future, and it can be so much better. It's
Well, I was hoping that all politics is rational, but apparently not.
So I have learned a lot about a really interesting community of farm credit directors. And the farm credit system is really interesting. It's how agriculture is funded in the U.S. and then it's a co-op system. So the directors of the farm credit banks are also farmers. And they've leaned on me for ESG executive education for the past couple of years. And what is incredible is that they understand that their crop yields, of course, are going down. They understand the impact of climate on their bottom line. And these are also family farms in many cases, so there's a deep emotional attachment and commitment. And they are deeply committed to addressing climate risk, to building, both carrots and sticks to be able to get to where they need to go for financial reasons, but also for social reasons. So I think when you look at things at that local level, it actually makes me more hopeful, and the November election becomes a little bit less relevant, because the thing that I should say is that in terms of political affiliation, these students are 95% Republican.
Yeah, so I don't know what's going to happen with the election. I don't think any of us know. And so I am curious to see. The areas that I've been paying attention to, and I'm interested to see what develops, is obviously what happens with the SEC rules. That's, to me, there's a potential for congressional action here, depending on who controls the House or the Senate, and what happens there, I think, is up for grabs, and whether there's going to be some effort to block those rules. We shall see. I will all be watching. I'm also interested to see what happens on the antitrust front, whether or not there are efforts to continue to enforce antitrust laws against those who wish to collaborate on these very important topics. So I don't know yet what's going to happen there, but I'm interested to see that as well.
Great. Please join me in a round of applause for our panelists. And should I give a preview for tomorrow?
Yes, let's do it.
Okay, perfect. What do you want to do?
Well, why don't we have our panelists have their seats? We're going to do some closing remarks and some logistical notes before, and I really, really am aware. I was looking at the bar. It looks really nice right now. So bear with us. But Stavros, I'll hand it over to you, and then we can.
Okay. So I just wanted to thank you all for coming and say that we have a very exciting program for tomorrow as well. We're going to discuss corporate structure and how social enterprise can help with climate change. We're going to have 2 breakout sessions, and in the breakout sessions, you will be able to raise your own questions. And these are not going to be recorded or live streamed, so you can be as free-minded as you want to be. And one of them is going to be on nature-based solutions, and the other one is going to be on carbon accounting. We're going to have a very interesting lunch conversation with Christine Casper, the General Counsel of Greenpeace, who's going to tell us how she's going to sue all of you. And then we're going to... the nicest possible way. And then we're going to close with a role with how lawyers can bring change in the corporation from within. So we have a very exciting day for tomorrow. Thank you all.
Thank you, everyone. Before we depart, first of all, I have to do a round of thank yous, actually. My mistake in that at the beginning of our remarks, I did not mention, but our co-hosts, the ABA and the Center for Law, Environment, Energy, have been so generous to support us in marketing and branding out this event. So if you heard about us through any of them, please do share some congratulations and thanks to them as well. We are also extremely grateful and indebted to our sponsors, including Accenture, Morrison Forrester, Weil, and Freshfields. They are the reason we were able to put this very nice, beautiful event together. And then we couldn't do it without the support of the stadium staff. If you have felt that this has been a very seamless AV experience, or that you found this place easily, it is because of their efforts. And then finally, our planning staff, our planning team, Delia, Lanique, Sylvia, Stavros, myself, Melissa, Lori, Irene, our student assistant, we have been spending sleepless nights on this. So if you get a chance to say hello to them, please do that. Say hi, meet them. And then finally, thank you to our speakers who showed up, are talking about these very important and sometimes difficult conversations to have, but one that has been timely and maybe beyond due to be had. So very, very big thank you to all of you for being vulnerable with us about your opinions, your thoughts, and creating an open dialogue. And then finally, thank you to all of you for staying with us from the beginning to the end, hopefully also tomorrow. It is not lost upon us that you have to either cross a bridge or go around a peninsula to come here. It is also a spring break time for a lot of folks. So again, thank you for being here. And then finally, follow us on LinkedIn. We have a hashtag, Berkeley Corp Climate Summit 2024. Tag us, promote us. And then with that, thank you. A round of applause for all of us. And then drinks are served to the right.